Alright, hello again. We're going to do something a little bit different now in this video. We're going to go through a review for the midterm exam. So, not to worry if it takes more than one video to cover all 6 chapters that are going to be covered on the exam. That's what we'll do. And I've got the trusty little whiteboard here to help us along. And that's my cat's tail waving around the top there, in case you're wondering. He likes to keep me company, I guess, when I'm downstairs doing things like this. So, Chapter 1. To just briefly summarize the things that you need to know in Chapter 1 to prepare for the exam. That's, you remember, the introduction to financial statements. And we start with the basic accounting equation, assets equals liabilities plus owner's equity. And then owner's equity branches off into pieces, the primary pieces called retained earnings and common stock. And then to go further, the retained earnings are comprised of either a net income, which is a positive to retained earnings, or a net loss, which is a negative, and dividends, which is also a negative. You need to know the 3 main types of businesses, the advantages and disadvantages of each, as were discussed in the chapter and in class. You need to know how net income is determined and how retained earnings are determined. And you remember, of course, the income statement and the statement of retained earnings, and of course the balance sheet. And then we talked about this in a later chapter, but asset accounts have debit balances, liability accounts have credit balances, and owner's equity accounts also have credit balances, and that's why the accounting equation works the way that it does. So that is a brief summary of the things you need to know for Chapter 1. And of course, you need to understand how to put the financial statements together, as I mentioned, regarding the income statement, the statement of retained earnings, and the balance sheet, and then later on a statement of cash flows as well. And understand how the various parts of those fit together, so that if you're asked to just do a piece of one of those, you can do that as well. Now moving on to Chapter 2 and what you need to cover there. Get him out of the way. And Chapter 2 was more on the financial statements. So here you need to be able to identify the sections of the classified balance sheet, and this is where we got into the various ratios for analyzing profitability, liquidity, and solvency. The relationship between a retained earnings statement and the statement of stockholders' equity. There's a little bit of difference there in that the statement of stockholders' equity is broader. It includes not only retained earnings but also common stock. And if there was any other kind of stock, such as preferred, that would be included there as well. The statement of cash flows and how you can evaluate solvency by looking at the statement of cash flows. The meaning of generally accepted accounting principles and financial reporting concepts. Well, let's boil that down to some more brass tacks here for you. So basically additional stuff on financial statements. Basically, if you're asked something about a current asset versus a property, plant, and equipment asset versus an intangible asset, you should have some idea of some examples of each of those. The same thing for liabilities, current liabilities versus long-term liabilities, and that's some of the important stuff you'll need to know there. And again, stockholders' equity, which I'm abbreviating SE, basically equals retained earnings plus common stock for most of our purposes. You go into more advanced accounting, and there will be other types of stock like preferred that will come into play more so, but for our purposes, stockholders' equity equals retained earnings plus common stock. And remember that retained earnings, by knowing what's in the statement of retained earnings, you have a beginning balance, then you have at the end of the period either the net income or the net loss, which again, the loss would be a negative, and if there were dividends paid, this is where they show up. Remember, not the income statement. Dividends is not an expense, it's its own category of account. It does have a debit balance like an expense, but it is not in the income statement, it's in the statement of retained earnings, and you get your ending balance of retained earnings by going through all of that with the beginning balance, the net income or loss, so add or subtract that, subtract the dividends, you get your ending balance of retained earnings. You add that to the common stock balance, you get your overall stockholders' equity. All right. So again, know what a current asset is, and also in terms of what that means as far as its useful life, which is basically expected to be one accounting period or less, that asset will be basically used up. And again, know the difference between that, the current asset classification, and property, plant, and equipment. So an equipment item would obviously go into the PP&E. It would be a depreciable asset that could be depreciated over 5 years, 10 years, 20 years, whatever would be appropriate for that item. The periodicity assumption, that means, again, that the accounting information can be captured in separate, distinct, and equal periods. And as we moved along, we could see how that could occur in the most accurate way by the use of accruals and deferrals, and making adjusting entries at the end of each period to capture the revenues and expenses in the appropriate period in which they're supposed to be captured. So know the definition of generally accepted accounting principles. They're rules and practices that act as a general guide for financial reporting purposes. Now, so then the ratios, the current ratio, and it helps to know on this that the current ratio and working capital are pretty closely related. They both have to do with you looking at current assets and current liabilities, right? So the current ratio is the ratio of current assets to current liabilities, so you would simply divide current assets by current liabilities, and you would get something that was hopefully greater than